One more before we go to break, and that's Under Armour. Favorite brand of mine, I must say. I really think this one is coming on strong. It's the same branded performance apparel, started by a guy called Kevin Plank out of Baltimore in the United States of America, but they've really charged hard. Bit of wild share price movement, but that's because they're spending so much money. They haven't been all that profitable, and they're going after the US athleisure market hard. Market cap, $12.33 billion. It's complicated though, because it's got two classes of stock. You've got to add the two together. I think, in fact, if you take the two, the UAAs and the UAs, you probably get to twice that, which is around $25 billion. Price earnings ratio 37, not in the dividend paying mode.
Yes.
Interesting company, no?
It is. I mean, fantastic brand, and it's exciting, and it really gets investors' emotions up when you talk about this. It is emotive. You walk into one of their flagship stores, from what I hear, it is mind-blowing.
They've spent a lot of money on them. I mean, I was in one in Boston, which has got a whole lot of Tom Brady, New England Patriots football star. They've got like a huge model of him. They're like moving graphics around the wall, thumping music going on. I mean, it's just a very expensive and visible, aggressive business strategy.
And that's kind of their thing. What they have been good at doing is picking those stars. So you mentioned Tom Brady, MVP of the NFL, Jordan Spieth in golf, and there's a number of others that are.
Steph Curry in the basketball market.
In basketball, also MVP for the NBA there. So yeah, they've been really good at that, but they spend the money, and that's that expense of endorsements has actually weighed on profitability somewhat.
And their strategy is more direct to market, so they do a lot of online sales, plus the concept stores, for example, in New York City at the corner of Central Park, they're buying out and redeveloping an iconic toy store, FAO Schwartz, which went into insolvency, so they bought the space and they're going to be doing it, and that's right behind that Apple glass cube on 5th and Central Park West. So, you know, going after it, man. Going after it.
Definitely their strategy. I thought what was interesting and where they've really seen growth recently is in their footwear. So a lot of their running footwear, trail running footwear, active
I got
wear.
a couple of pairs of those, exactly. Shoes priced well above $100 a pair, and kind of new innovative designs and so on, giving it a full wind.
Yeah, and so far from what I see, they've been really well received by the market, so they're pushing that.
Let's look at the share price, and I'm almost scared to put it up because it's going to look like nothing. That's because they did another share split reorganization. It actually does have a prior track record than that. But they did a split similar to what, say, a Google Alphabet did, and that's to retain control of the executive team. Then they changed the codes from UAC to UA and from UA to UAA. It's been very confusing. All I guess people need to know is that you can now buy, again, the UA, as it's shown there, which is the C-class share, which is the one that will be in issue in larger numbers and more liquid. The stock price, though, hasn't done all that well. A major catalyst for it, the share price, I think, is going to be the Q4 results, which are going to be brought out now on the 31st of January. If they do well, if festive season sales were good, if margins were good, and if there's growth momentum, they'll probably go higher. If there's any sense that they're disappointing and that CapEx is too high, they're going to take a dive. So, kind of a binary one.
Well, that's it. And, you know, with a growth company like this, they will experience these growing pains. You know, if their revenue growth is a bit light, profit growth a bit light, the market is going to punish you because you're paying these elevated multiples for it. I mean, I think by and large, they've done well. They do have much thinner profit margins than the other two companies we've already spoken about, and that is a concern. So if they get it wrong, you can see profitability move back very quickly. So I'd look at that,
Hot or not?
This one's always a tough one. I mean, love the brand, love the company. You're just buying growth at a big multiple. I think you're probably going to get a better price. So for me, I'm going to wait and not hot.
Okay, I'm going to go hot on it. We'll see how that pans out.
Yeah.
I think you could be right.